Hi everyone, it's Caitlin and welcome back to Your Financial Journey. In today's video, we're going to be talking about the 50-30-20 budget. Many budgeting newbies start with the 50-30-20 budget because it's one of the easiest budgeting methods out there. With the 50-30-20 budget, you allocate your after-tax income to 3 separate buckets. After-tax income is basically your take-home pay, the amount that actually hits your bank account every month. 50% of your after-tax income goes to your needs, 30% to your wants, and 20% to your savings plus debt repayments. Needs, the 50%, are the day-to-day expenses you have to pay, no matter what. The expenses that we talked about earlier that your 1-month emergency fund must cover even if you were to lose your job today. So, your rent or mortgage, your utilities, transportation, basic groceries and clothing, as well as your minimum insurance and debt payments. Wants, the 30%, are generally speaking the nice-to-haves that aren't essential to daily life and work. Wants can include things such as subscriptions, eating out, entertainment, tech upgrades, taxis, and travel. So if my after-tax income is $4,000, 50% of $4,000 is $2,000 for my needs. 30% of $4,000 is $1,200 for my wants. Now, figuring out what's a need and what's a want isn't always easy and can differ from one person to another. For example, groceries and clothing can go both under needs and wants. That's because there's a certain basic level of groceries and clothing that are needed to survive. Think along the lines of bread, rice, and vegetables for basic groceries. And think along the lines of undergarments, shoes, and a coat in winter for basic clothing. These are needs, the 50%. The likes of sushi, caviar, and truffles, or Louis Vuitton, Prada, and Gucci, these food and clothing items would be categorized as wants, the 30%. While I would have personally loved to put them in the needs category, I wasn't quite able to convince my parents. In any case, and likewise, for transportation, there is a minimum level of transportation you need to get you to and from work and other places. That minimum level of transportation is a need. And then there are the taxis you take because you're just too lazy or tired to walk. That's a want. So when you think about your spending in the categories of food, clothing, and transportation, really be honest with yourself. What is a need and what is a want? Of course, we all have wants in life. The issue is when we want too much right now instantly. Instant gratification, and instead of saving for those wants, we charge them on a credit card even though we know we can't afford it at this very moment, and we end up running up a credit card balance and paying 20% or more to the bank because we want it and we want it now. As my parents always say, if you really want something badly, then save for it, which leads us to the 20 in the 50-30-20 budget. 20% of after-tax income should go towards savings and debt repayment under this budgeting method. Again, if my after-tax income is $4,000, 20% of $4,000 works out to be $800 for my savings and debt repayment. Savings can include an emergency fund, a travel fund, house fund, or any other savings, investment, or retirement account. And debt repayment can include items such as credit card debt, student loans, personal loans, car loans, and any other type of outstanding debt. Just as groceries, clothing, and transportation went under both needs and wants, debt also goes under 2 categories in the 50-30-20 budget. As you can see here, minimum monthly loan payments go under needs. That's because this is the amount that you have to pay to your lenders every month, no matter what. If you don't, it will have a very, very bad impact on your credit score and limit your future borrowing opportunities. The debt that goes under the third bucket, the 20% for savings and debt repayment, this refers to any debt payments that are above and beyond your minimum monthly loan payments that are categorized under needs. Do also keep these 2 things in mind about the 50-30-20 budgeting method. First, living in a high cost of living city. If you live in the likes of New York, Los Angeles, or Seattle, for instance, you might find that your needs easily take up more than 50% of your after-tax income. Second, having lots of debt. If you have lots of debt outstanding, putting 20% of your after-tax income towards saving in debt may simply not be enough to ever get you debt-free. You may need to put 25 or 30% of your after-tax income, possibly even more, towards savings and debt repayment. which means you'll have to lower the percentage of your after-tax income that you allocate to the first two buckets of needs and wants. So if you find that you fall into either one of these groups, you live in a high cost of living city, or you have a lot of debt, you'll just need to play around with the percentages a bit until you come up with an allocation that works for you. Whether it's 60% needs, 20% wants, 20% savings and debt repayment, or 50% needs, 15% wants, and 35% savings and debt. Okay, my financial friend, I hope you found this video helpful. If you're trying to boost your savings bucket a bit, then please refer back to this video here for some ideas on how to increase your income, or the one here on 5 top savings tips to lower your expenses. And do leave a comment below and let us know what other money topics you'd like us to cover in the future. Thanks for watching, and we'll see you again next time.